Wednesday, I told you I was watching two stocks. NVDA at 204 to 205, CAT at 905 to 915. Waiting for the FOMC dip. The FOMC delivered, but not the way anyone expected. The dip happened, but one stock didn't dip at all. New here? Subscribe. Free watch list in the description. NVDA dropped to 204.65, down 1.33%. That's the zone, 204 to 205, the level we said we'd look at. And here's the thing, a lot of people probably bought it there, and now they're holding it into triple witching Thursday, wondering if they made the right call. Let me give you my take. The good news, NVDA hit the zone on conviction, not panic. Volume was 128 million shares, elevated but not panicked. The bond signal we talked about, $25 billion, 3.4 times demand. That's still there. Smart money didn't sell the bond because Warsh sounded hawkish. The long thesis hasn't changed. The bad news, the rate backdrop did change. Warsh said 5 years of inflation failure, time to fix it. The dot plot went from 0 hikes expected to 9 members wanting at least 1. The 2-year yield shot to 4.21%. When rates reprice upward, tech multiples get squeezed, even NVDA. The 50-day moving average is near 210. NVDA is already below it, so the technical picture isn't clean. It's a conviction trade now, not a technical trade. Here's my setup for Thursday. If you bought at 204 to 205 yesterday, you're in. Hold. Stop at 198. If triple witching flushes it below 200, the bond thesis is under serious pressure and you don't want to be there. Target still 215. You're risking 6 to 7 points to make 10. Not amazing risk reward, but it's a conviction play, not a probability play. If you didn't buy yesterday, honestly, you might have the better position. Triple witching Thursday means quadrillions in options expire. These events create intraday flushes. If NVDA gets washed to 198 to 200 and bounces, that's a cleaner entry than buying at 204 yesterday. Stop at 192. Target 215. Better risk reward. More patience equals better prices. One scenario I'd avoid. NVDA opens Thursday at 206. You get FOMO, you buy. No setup. Just emotion. Don't do it. Caterpillar. Completely different story. CAT went up on FOMC day, plus 1.11% to 955.92. It touched 975 intraday, another all-time high. On a day the S&P dropped 1.21%. On a day Meta got crushed 5.4%. On a hawkish Fed day, CAT didn't care. The industrial supercycle doesn't answer to Kevin Warsh. The trend is undeniable. Infrastructure spending, Iran deal, lower oil equals lower input costs. This is a real economy story, not a rate story. And the chart, CAT has gone from 354 a year ago to 955 today. That's 163% in 12 months. The trend is your friend until it isn't. But here's the problem. I'm not buying an all-time high the day before the market closes for a long weekend. Triple witching Thursday, Juneteenth Friday, markets shut. You want to hold a leveraged industrial name into 3 days of no price discovery? That's not conviction, that's gambling. My CAT setup. Wait. If triple witching triggers a broad sell-off and CAT pulls back to 920 to 930, that's the entry. That's roughly a 3% pullback from current, reasonable for an expiry shakeout. Stop at 885, below the 20-day moving average, hold through the long weekend. Target, let the trend work. The catalyst chain is intact. You just need a better entry price. If CAT doesn't pull back, you skip. CAT has been running. Trends rest, trends pull back. You don't have to catch every move. The industrial supercycle has months to play out. Two stocks yesterday, two very different outcomes. NVDA hit the zone, CAT hit new highs, and now the question is the same for both. Do you have the patience to wait for the price you want? Or are you going to chase? You know what I think. One question, did you buy NVDA at 204 yesterday or still waiting? Drop it in the comments. I want to know how many of you pulled the trigger. You know the drill. Subscribe, hit the bell, watch list in the description. Good luck out there.